Hi, I'm Wayne Zell, and welcome to Blueprint for Wealth, a video cast dedicated to helping entrepreneurs, executives, founders, and business owners to realize their personal dreams of wealth and freedom. Blueprint for Wealth is brought to you by the law firm of Zell Law, located in Reston, Virginia, and Savannah, Georgia, and serving clients all across the country. If you'd like to know more about us and the services that we provide, visit us on the web at zelllaw.com. Today, it's the continuing discussion of choice of entity. We've talked about sole proprietorships, partnerships, the many different kinds of partnerships that exist today, limited liability companies, and today we're going to talk about the granddaddy of all corporations. So stay tuned, here we go. And by the way, we're going to have a special guest at the end of this episode, so stay tuned, don't leave us. Corporations have been around the longest of all the different types of entities, with the exception of sole proprietorships and partnerships, which date back to Elizabethan times. But corporations are a statutory creature, meaning that according to state law, they can be created if you follow certain requirements. And if you do those requirements and you follow them carefully, and you set up the entity carefully, and you follow the corporate formalities, then you can limit the liability of owners of the corporation, known as shareholders, to their own personal investment in the entity. So generally, the owners, the shareholders, are not personally liable for corporate debts in a corporation. But they can be liable in certain cases. For example, I'm asked to personally guarantee the borrowing of the corporation, which is a separate entity, to buy a piece of property, to start a business, get a line of credit. They want me to sign on the dotted line. And if I own 20% or more of that entity, they're going to ask for my personal guarantee. Taxes, such as payroll taxes, sales taxes. If you are the responsible party for basically collecting the sales tax or payroll tax out of your employees' paychecks, and you fail to remit them to the appropriate governmental authority, you can be held personally liable for those taxes. If you're negligent, or you engage in intentional acts of willful and wanton behavior, bad faith, or just gross negligence, you could be held personally liable, even though you may be limited by the corporate limited liability shield. And if you are involved as a majority shareholder in the company, or as an officer of the company, or a director of the company, and you do something that breaches your duty of care or loyalty to the company or its shareholders, you could be held liable personally for a breach of fiduciary duty. The most important one that I like to emphasize every time I talk to a new client or an existing client is, are you respecting the corporate formalities? We'll talk about that in a little bit, but corporate formalities include not just setting up the business right, but operating it right. Do you have annual meetings of boards of directors and shareholders? These are the corporate formalities that must be followed. Do you keep separate bank accounts and separate books and records for the corporation? These are the formalities that must be followed to prevent a creditor from trying to pierce through the corporate veil of liability protection and go after your personal assets. Now, corporations generally, when they're set up, are treated as what we call a C corporation, which is known as a regular corporation. C corporations are treated as separate taxable entities under the tax law. It's different in the United States than it is in many other jurisdictions. They have the limited liability company model in many other jurisdictions. But in the U.S., we have a separate corporate income tax that's imposed on the company. It is imposed on the profit after deductions, which is referred to as taxable income. The highest rate under today's law is 21% on a corporation, but in the past, the highest rate was as high as 35%. The Trump administration and Congress lowered that rate to 21% beginning in 2018. And it's a permanent change, but there are legislative proposals currently offered in the Congress that would raise the rate in between the two rates to as high as 28%. In addition to the corporation paying tax, the shareholders pay tax on dividends or distributions that are made to them. The highest rate on individual shareholders is 37%, but certain qualified dividends are only taxed at a 20% rate. Again, legislative proposals are pending that would increase the tax on dividends to a flat 39.6% and do away with that lower rate on dividends, which would hurt virtually anybody who's receiving dividends from a corporation. Corporations also, because they're separate entities, have special treatment. They can engage in tax-free mergers and acquisitions with other corporations. And they also qualify for a very special exclusion. If you qualify as a small business entity under Section 1202 of the Internal Revenue Code, any sales of stock by the shareholders can be exempt from capital gains tax and ordinary income tax if the requirements of that statute are met. We're going to spend a special episode of Blueprint for Wealth just focusing on Section 1202 because it's definitely worth talking about. And a lot of my technology startups start out as C corporations because they intend to take advantage of this qualified small business stock exclusion. Now, there's also a special entity known as an S corporation. S corporations are sort of a hybrid between a corporation and a partnership. It's not a pure flow through of income and losses, but it generally does flow through to the shareholders. Tax can be imposed at the corporate level, however, in certain cases. So in some cases, the S corporation is treated like an entity. For example, if the S corporation originally started out as a C corporation and then tried to convert into an S corporation, there may be built-in gain on the certain items of income and certain items of appreciation inside the S corporation within a certain period of time. This built-in gains tax, again, applies very special rules that are beyond the scope of our discussion today, but we should talk about it in the future. Because when you're considering converting from a C Corp to an S Corp, you always have to consider this built-in gains tax. And S Corps are not recognized in all states. There are certain states that would impose a separate corporate franchise tax or corporate tax on the operations of S Corps. They qualify for tax-free mergers just like C Corps, and there's some benefits when you are attempting to sell your S Corp. One benefit is that the buyer can treat the S Corp sale of stock like a sale of assets. That may not be in the best interests of the S Corp holders. They can make an election under either Section 338H10 or 336E of the Internal Revenue Code, and they can treat the sale of the stock as if it were the S Corp selling the assets. And so the S Corp owner has to be really careful when they're negotiating a sale of their business because the buyer is going to want to treat it as a sale of assets so that they can write off the goodwill that they're purchasing over 15 years. The buyer may not want that treatment if there's accounts receivable in excess of payables inside the business or there's depreciation recapture, all of which will be treated as ordinary income on the sale, taxable at the high rates, 37% currently. And we may come up with unique structures involving S corporations in certain types of acquisitions, particularly by private equity firms. They may want to structure the sale as an F reorganization, which allows for the taxpayers in the S corporation, the shareholder S corp shareholders, to treat the sale as if it were a sale of stock or assets, depending on the structure, But if they receive any kind of rollover equity in the private equity deal, they don't have to pay tax on the receipt of the rollover equity. So it's a complicated structure. Again, it involves a whole nother series of discussions that we'll deal with at a later date on Blueprint for Wealth. Corporations require special formalities to be formed. You have to file articles of incorporation or a certificate of incorporation in the state in which you're being formed. In addition, if you want to operate in a jurisdiction outside of your state of formation, outside of Delaware or outside of Nevada, and you're operating in Virginia, you're going to have to register the entity as a foreign corporation and pay fees and taxes in that state. The filing fees can be very significant for corporations, and they vary from state to state. There's the annual filing fees as well to keep the corporation in good standing. There may be franchise taxes imposed based on the number of shares you have authorized. So Delaware imposes a franchise tax on authorized shares, as does Virginia. There usually will be registered agent fees. If you incorporate in a state outside of the state in which you reside, you may have to pay somebody to serve as your registered agent, who is therefore able to receive service of process and avail yourself of all of the benefits of operating within that state or incorporating within that state. You also need to consider federal and state securities laws, because shares of stock in a corporation, as are units of interest in an LLC, considered securities. And if you're selling securities to an outsider or third party, you need to comply with the federal and state securities laws. The state securities laws are known as blue sky laws, and every state has its own set of rules. There are exemptions from registration, exemptions that allow you to sell to people that you know, friends and family, or other investors. And those exemptions are important to satisfy in order to avoid federal registration requirements. The bottom line with corporations is follow the corporate formalities. Adopt bylaws to operate the corporation. Hold annual meetings of shareholders and directors and document these meetings in minutes that you put in your corporate stock ledger or your corporate minute book. Keep separate books and records from your individual accounts. Have separate bank accounts for the corporation. Issue stock and issue stock certificates, or if you can get around issuing stock certificates, maintain a stock ledger. The state in which you are incorporated will tell you what the rules are regarding stock certificates and stock ledgers. And most importantly, you should adopt a board of directors, hold meetings, and again, take minutes. Some states in their state corporation statutes allow you to bypass the need to appoint a corporate board of directors. So look at your state statutes and decide whether or not it's prudent to have a board of directors help you operate your corporation. If you'd like to know more about corporations, how to set them up, how to operate them, how to govern, how to establish all of the formalities and meet all the formalities of operating a corporation, give us a call at 571-203-ZELL or visit us on the web to make an appointment with one of our attorneys at zelllaw.com. Thanks for listening to Blueprint for Wealth, a video cast designed to help entrepreneurs, executives, and founders and business owners realize their personal dreams of wealth and freedom. I'd like you to stay tuned for our special guest, who's an entrepreneur who's got a great story to tell you about their journey to success.